Welcome to Industry Insights. Thank you for joining us for today's episode, Unpacking Tax Changes, What Actually Happened. So as always, we know how valuable your time is. And as always, we can assure you, no matter what role you play in real estate today, this will be time well spent. It is my pleasure to now introduce today's special guest, Tony Watson. Tony is an enrolled agent who focuses on providing personalized financial guidance and tax preparation services for individuals and for businesses. He is a federally licensed tax practitioner. So he helps his clients make not only sound financial decisions, but he covers things such as making sure they're getting all eligible deductions when they're preparing their taxes. He helps with audits, collections, appeals, because he is empowered by the U.S. Department of Treasury. So he's able to actually represent taxpayers before all administrative levels of the IRS. Tony works with clients in multiple industries, but obviously today his focus is going to be on his expertise in real estate. So let's give Tony a warm welcome as he's going to share his top tax tips and talk us through unpacking all of the tax changes that have happened this past year. So welcome, Tony.
Welcome, Tom.
And taking the mic with our guest is today's host, President and CEO of CIVIC, Bill Tessar. Bill has over 35 years in the mortgage industry. He is our true visionary lending leader, and he just continues to elevate the private lending space, in addition to sharing his knowledge, which is a hybrid of far beyond the private lending space. Since joining as CEO in 2017, he has led CIVIC to some major milestones and developed the people and culture that continue to make CIVIC successful today. He is a Glassdoor top CEO, a HousingWire Vanguard Award recipient, and most recently the 2021 AAPL, which is the American Association of Private Lenders, Lender Member of the Year for 2021. So congrats, Bill. And he is just an all-around leading voice in the lending industry. And these episodes bring him much joy to be able to give back to the community that we serve. So without any further ado, kicking things off today, Bill Tessar.
Thank you, Gina. Yeah, these are actually my favorite moments of the month. Most importantly, because I get something out of it as well, not just giving. Some of the speakers we've had on recently have just talked about some really dynamic positions and perspectives on the market. Why Tony actually has spoken more than any other speaker. And to Gina's earlier point, I could have him on for hours if we weren't being thoughtful of everyone's busy calendars. It's just so much positive information. And I think the one global takeaway where all of us walked out and go, okay, I got to think about this different from the last time, was really about your approach to taxes. And I think for the most part, for those taxpayers in the world that approach April 15th, it's an event. On April 15th, they find out what they owe. And I think, the big takeaway from Tony is it's not an event, it's a day, but this is really a process, and the process of about how you could apply the tax code, which is 70,000 items or pages, or 4,000 pages, 70,000 items, changing every day, and how that applies to you. How do you save the money that you're making? And when you start thinking about it that way, your tax year actually starts the moment after you filed your returns. And I could just tell you, like, I talk to Tony an awful lot and find out something new every day. And I've been paying taxes for over 3 decades. So it's like, I'm excited because I think every one of you will walk away with something that you could apply to your own situation and you will benefit from. And if any of you from the last time we spoke didn't get a chance to reach out to Tony and have him take a look at your personal situation, you should do that. Tony and I have talked personally, and I had the same accounting team for over 20 years. And I'm proud to tell you that I'm working with Tony now, something I don't normally talk about with my speakers, but I actually switched the last time he spoke. It's just, he was that impactful, and he had an impact on me. And I think the last time, just jumping right in, Tony, off the heels of that, we had a new administration. There was a lot on the table about what could and couldn't happen. And maybe we can start with what has actually happened since then.
Sure. So thank you so much again for having me back. I always appreciate speaking to like-minded individuals as a real estate investor myself, as a person who owns multiple businesses. My wife is self-employed, so I very much practice what I preach. So, for the 160 plus people in today's webinar, hopefully we can leave you with a little nugget of information to bring out into the real world and apply on your own taxes. The last 2 years, make no mistake, have probably been the most significant years of all of our lives, I would have to assume, not only from a financial perspective, but just from a human perspective. And the federal government had passed many, many changes to the Internal Revenue Code starting at the beginning of the pandemic. One thing is for sure, it keeps me gainfully employed, so I'm not going to complain about all of these changes. But it did cause some concern in our industry because of the information changing so much in such short periods of time. The pandemic kind of caused this whole relief plan movement over the last 2 years. Obviously, we've seen the checks that are being cut by Uncle Sam to help support our economy during uncertain times. But at the beginning of the pandemic, when the federal government was dialing in the vaccines and what they were going to do to help people who were out of jobs and businesses that were closing down, they introduced the CARES Act. And the CARES Act was really the first monumental change to the Internal Revenue Code, changing parts of the IRC that had been around for 50, 60, 70 years. Fast forward to 2022. Now we're in the midst of the 2021 filing season. That CARES Act alone has changed what I have counted, and I'm sure it's more, but what I've kind of gone back and dialed in, it's changed over 35 times since its inception. Now that is unheard of. That is just mind-boggling to me, because when you pass an 8,000 to 9,000 page change to the code that introduces new credits and different changes to real estate deductions and accelerated depreciation, it's always a little concerning to me, because how do I get that information out to my clients as quickly as possible? Well, in 2020 and 2021, on average, each of those years, we were doing 160 webinars to bring all of that information to our clients. So we were busy trying to get that information out to people. But as far as what is set in stone for 2021 and 2022, 2021 is going to be very, very similar to 2020. We have the CARES Act that introduced accelerated depreciation benefits, which we'll get to in a little bit. But then also in 2022, we have this new tax code on the horizon. And we know for a fact that that actual brackets are going to change, because they always change each year. Standard deduction is going to change. It's going to bump up to, I believe, 25.4. All of these things we know for a fact are going to change, but the things that are still kind of looming on the horizon are the major changes that could potentially be the, not the downfall, but the significant alteration of industries, such as the 1031 tax deferred exchange industry, section 1031 of the IRC, and also capital gains. So we'll talk about that in a little bit more detail. I don't want to get ahead of myself, but these are things that we're still waiting on to be signed off. As far as the brackets changing, standard deduction increasing, those things are very common based on inflation, based on deflation, based on how the economy ebbs and flows. So we know for a fact that those will change. The brackets, you can find them online, but really what you really want to focus on are two numbers, in my opinion, especially if you're good in real estate. $400,000 tends to be the number that people are talking about more often these days. And that will very much be a changing number. As soon as you kind of increase your income above $400,000 in adjusted gross income, you will tend to phase out from a lot of the benefits that are built into the 2022 Internal Revenue Code. But one other bracket that Bill and I and many, many of my clients really talk about, because we all want to make money in real estate. And let's face it, if you have one good deal in 1 year, it could easily put you above this income threshold. That number is $509,000. 509,000, you're thinking, well, I'm way off from that. But once again, you sell one real estate deal without doing a 1031 exchange, the capital gain recapture depreciation could easily bump your W-2 and all of your other income above 509,000. And that's really where the major changes start to be implemented, because you lose, parts of the qualified business income deduction. You lose benefits in the capital gain, the lower long-term capital gain rates. So once again, we'll get into more detail about that, but a lot of things are still on the horizon. We do know a couple things that have kind of been set in stone and probably won't change when the bill is finalized. But there's a lot to look forward to on the horizon.
So 2021's in the rearview mirror, but 2022, we're basically 2 months in. The changes aren't set. Is this going to be for 2022, or how are you thinking about that?
I very much think that it will be passed and it will be retroactive to the beginning of 2022. That's my personal belief, because I have to go off what happened in 2018, right? That's what we kind of have to go off of in the tax industry, is what happened last time a bill was passed. And in 2018, if you remember, that at probably the 23rd hour, right, kind of at the beginning of tax season, the 2018 tax reform bill was passed, and parts of those bills were actually retroactive to December 15th of 2017. One thing in particular was the deductibility of mortgage interest on a primary residence, where it dropped by 250 grand. Prior to the 2018 tax reform bill, we could deduct interest on up to $1 million of acquisition debt on a primary and $1 million of acquisition debt on a second home. If you bought a property after December 15th of 2017, so lucky you, if you bought that and closed on that home in the last, 16 days of 2017, you had to play by the new rules. You were not grandfathered into the old part of the Internal Revenue Code. So the government absolutely has the ability to make things retroactive to 2021, even though we're already in February of 2022. I don't foresee a lot of that happening, but I do believe that whatever passes this year, it will be a start date of January 1st of 2022.
So a biggie leading up to COVID was you always had those folks that owned real estate, and maybe a small piece of their residence was used for work. Today, now that we're 2.5 years into COVID, most workers are working from home. I think in our company, out of 420 people, a third of them are full-time at home, a third of them are hybrid 50-50, and then a third are actually coming to the offices. Is that being looked at any differently from a tax deductibility standpoint? Can you write off part of your kitchen now that's your cafeteria, or like the hallways treated differently, or how are they viewing square footage and that sort of thing?
This is why Bill and I work together, because I love where his head's at. He's just thinking of different ways to utilize this benefit. And I very much think I have a personal opinion about this, and I have obviously my professional opinion about this. Professionally, I've always known that the actual deduction itself of an in-home office is not why people get audited. It's not the form itself. It's the allocation the taxpayer uses for business space versus personal space of the in-home office, or the actual home itself. And so I always tell clients, do not be afraid to take the in-home office deduction as a write-off, because it is very much an ordinary, necessary, and legitimate deduction. I've seen a lot of new clients coming on board with us over the last 2 years, and you'd be surprised at how their other preparers have kind of made the taxpayer scared or put them in a position of fear by taking this ordinary, necessary, and legitimate write-off. Now, sure, does the in-home office deduction have a higher risk for audit? Prior to the pandemic, that particular form alone ran about a 70% chance for audit. It was one of the highest audited forms on an individual or personal return. And it's the in-home office deduction form, where you put your mortgage interest, your property taxes, your insurance, your improvements, depreciation against the property, portions of your HOA dues. But remember that the only allocated deduction on that form is whatever percent of the home that you use for business use, right? So imagine this. Let me just give you a really quick example. Here in Los Angeles, I have clients who bought $1.5 million, 1,200 square foot homes in Los Feliz or the Hollywood Hills. And then we have the clients who bought $1.5 million homes in the Valley, and they are 3,000 or 4,000 square foot homes. So if I got on a webinar and I told everybody today that they should be allocating 25% of their home for business use, well, 25% of 1,000 square foot property is 250 square feet. Pretty decent size office, a reasonable allocation in my mind, in the IRS's mind, and probably the general public's mind. But if I told a person in the Valley that has a 4,000 square foot home that they should use a flat 25%, that would make 1,000 square feet of their home an office space write-off. And so they're getting 25% of the mortgage, 25% of the utilities, so on and so forth. So remember that you can't just go off of an industry average in this case. You actually have to go into your space and hopefully measure. But if you're estimating, you have to be reasonable with your estimation. You should never be afraid of taking this as a write-off, because once again, it's ordinary, necessary, and legitimate. And if you're working with a tax advisor who is licensed to represent their clients in front of the IRS, you should never be afraid of having to go to the IRS and explain your position. That's what we do for our clients. So once again, there's a little misconception about, how to write this off, why you should be writing it off. Does it have, or is it going to throw up a red flag on my return to get me audited? My professional belief is that in-home offices will always be high audited deductions because people are unreasonable with their allocation on the square footage side. But professionally, I also believe that you should be taking this because over the last 2 years, just like Bill had said, in our business too, we had 2 COVID outbreaks. So in 2022 already, we're only February 15th into the year and we've had 2 outbreaks. So we have 50 people working in the office when we're full blown in office. And then all of a sudden we drop to 23, 24 employees when we have to push everybody off site again. So these are very much ordinary and necessary deductions for taxpayers to take. Do not be afraid of taking this as a write-off. Just make sure that you're being reasonable with the allocation.
Yeah, kind of thinking, Tony, that if it was the #1 trigger point for IRS audits in the past, maybe that dissipates a bit just because the IRS knows you really truly have more people in the workforce working from home, not just part-time, but permanently. So I'm wondering how that kind of plays out in 2022, 2023 from that perspective.
My personal belief is that it will have a lower risk for audit. That's what I personally believe, simply because no one can argue that probably over the last 2 years, we've had more people working from home than probably in the history of the US Internal Revenue Code, right? So yes, from a personal belief, I do believe that. Professionally, I also believe that a little bit too, but I also know that the IRS is going to be trying to collect a lot of money over the next couple of years to pay back all of the money that they've been printing over the last 2 years. So I do believe that the unreasonable allocation will still have a little bit higher of a risk for audit, but I also do believe that the government will have a little bit of flexibility from an audit perspective. I know, just as a side note, I know we've heard a lot of these articles online and on the news media outlets about how the IRS is going to be hiring or has been hiring a lot more people as of late to work with the IRS. Understand that they are just trying to replenish what they lost. It's not like they're fully staffed as they were pre-pandemic and now they're adding employees on top of that number. They can't hold their employees. I mean, just like at other industries across the US, across the globe, they cannot keep people in those seats. And so what they're trying to do is replenish all of the people that they lost during the pandemic. And it's very difficult to keep employment these days at the government level. So take everything that you read online with a grain of salt. There's a lot of information that isn't explained in detail. Talk with your professional tax advisors about all of this and figure out how it might impact you.
Yeah, agreed. Hey, so last month we talked to Eddie Wilson from Think Realty, CEO over there, and he gave us a different perspective on viewing real estate and the acquisition of. And so what we talked about on the front end was the appreciating asset, home price appreciation across the board in most states in the USA. We talked about cash flows, the rental program, and he brought up a totally different play from his perspective, which was the whole depreciation and tax play of real estate. So maybe tap dance a little bit on that. I think it would be worthwhile our folks hearing like your perspective on that play as it relates to real estate.
Sure. Depreciation, in my opinion, is one of the key parts to building wealth in real estate. In the tax industry, we also refer to depreciation as a phantom expense, meaning that it's not you actually coming out of pocket to pay for depreciation. It's actually the value of your building that the government gives you as a write-off over either 27.5 years if it's residential or 39 years if it's commercial. Now, before I forget, I want to mention that under the CARES Act, something was introduced to the Internal Revenue Code called QIP, QIP. And it's not another variant of COVID. That's not what QIP means. QIP stands for Qualified Improvement Property. And Qualified Improvement Property at the beginning of the pandemic, when the CARES Act was first introduced, we in the tax industry thought, hey, this is great. It's going to be available for residential, for commercial. People are going to be able to take a major benefit for this as far as depreciation is concerned. And QIP would be Qualified Improvement Property would be any interior improvements that you make to a rental investment. Well, as once again, I told you that the CARES Act has changed over 30 plus times since the beginning of the pandemic. What the government didn't do is actually detail what properties qualified for it in the initial introduction to the CARES Act. So finally, after 2 or 3 months after the CARES Act had been introduced, the government had finally defined what QIP and what QIP was, number one, and what properties it applied to. And so we thought that it was going to be for residential and commercial. Fast forward 2 months after they introduced the CARES Act, it actually is only a qualifying deduction for commercial investments. But what QIP does is it allows you to fully gut your restaurant, fully gut your commercial property, make all of these great interior improvements when your business was really shut down during the pandemic. And all of those improvements, instead of having to deduct them over the depreciation lifespan of the property, which commercial is 39 years, you can imagine how little of a deduction you're going to get for that expense if you have to spread it out over the next 39 years, right? The government allows us to now accelerate all QIP, qualified improvement property, interior improvement property, and take it all in 1 year, all in the first year. Very similar to something called cost segregation, except they are two completely different parts of the Internal Revenue Code. So in my opinion, depreciation, that was the beginning of the QIP involvement. But my opinion has always been that depreciation, because we don't actually have an option of taking it or not, that's one of the biggest misconceptions about depreciation. The code is very specifically written to say that when depreciation is allowable, it must be taken. So you don't have the option of not taking depreciation. And depreciation, like I mentioned, it's a phantom expense. And it is actually one of those deductions on top of mortgage interest and property taxes and insurance and improvements that allows you to wipe out bottom line profit and cash flow in reality, but pay very little to no income tax on the actual investment itself when it comes to the tax filing. So I'm full blown on board for taking depreciation, accelerating it, making these elections. And Bill, I'm sure that you wanted me to dive a little bit into detail about cost seg for a couple minutes here.
That was my next question.
So cost segregation is something that has become, it's always been popular. Don't get me wrong, but over the past year and a half, I have probably done more connections with, file connections with cost seg specialists in the last 2 years than I have in the last 17 years that I've been preparing taxes. So we see people moving in that direction to increase deductions to offset rental income, decrease, obviously the taxable liability on the personal return or the business returns so that they can capture more of their revenue and buy more property. What cost segregation is it's the ability to move or to reach forward into future tax years and grab future year depreciation and accelerate it in this current calendar year. So imagine if you're waiting 27 and a half years to take a deduction or 39 years for commercial to take a deduction. If the government gave you the ability to elect to accelerate that future depreciation and take it all in 1 year, would you not do that? I mean, if you have a cash flowing property, let's just call it 50 grand of cash flow in the first year, and you're used to paying income tax on that 50 grand of cash flow, why would you not look at future depreciation, capture it in this year, offset the 50 grand, reduce liability, obtaining that wealth in your own business account, and using that money, that tax savings to buy more real estate? Because what happens when you purchase more real estate? You restart depreciation, you have new debt deductions, you have all of these other tax shelters that will help you offset moving forward the cash flow on your current cash flowing investments. So I have never thought of depreciation as a bad thing. I understand that when you get ready to sell the property, yes, depreciation, it can be the nail in the coffin from a tax perspective. And that's what creates this whole benefit under Section 1031 of the Internal Revenue Code, where you're allowed to exchange property for like-kind investments. As long as they're equal or greater in value and carrying the same amount of debt, you can defer the complete capital gain tax from here until the end of time. I joke with my clients about kicking the can down the road until you kick the can, right? Because that's in theory what a 1031 exchange does. You're kicking that tax can down the road until 20, 30, 40, 50, 60 plus years down the road. When you kick the can, then the benefit, the non-taxable benefit, goes to your heirs in the inheritance part of the Internal Revenue Code. So there are a number of ways to avoid the depreciation recapture, but as far as looking at depreciation as a bad thing, I've never looked at it that way. It is truly the on top of the mortgage interest and property taxes, all of these other expenses, it is truly the greatest way to fully offset cash flow and retain more of the wealth that you've built for yourself over the last 365 plus days.
Yeah. So for those that don't utilize 1031, talk to us a little bit about short and long-term capital gains and how that might impact some of our investors on the call in terms of what they're paying.
Sure. So there are major tax differences between long-term and short-term leading up to this new internal revenue code that once again, 80% of it is still kind of in the wind, 20%, 100% of the 20% will be set in stone. But the 80% that hasn't really been passed involves changes to Section 1031 of the Internal Revenue Code and also the long-term and short-term capital gain tax rates. Currently, as of today, long-term capital gain rates can either be 15% federal, and here in the state of California, 9.3%. The capital gain rate elsewhere in the US might be different, but 15% federal, 9.3% state of California. Or if you are making over a certain threshold of income, you can be subject to 20% long-term capital gain, 9.3%. And then also you get to pay this lovely healthcare tax, which is called in the tax industry a net investment tax, which is 3.8%. And that goes to you paying free healthcare here in the United States. That was introduced back in the Medicare days, or the Obamacare days, where he introduced the new medical plan and whatnot. That introduced an additional 3.8% on top of the long-term capital gain and the short-term capital gain. So right now that's where we stand, and 15 to 20% long-term, that sounds great, right? It doesn't matter if you make $100 million in capital gain, or it doesn't matter if you make $500,000 in capital gain. As it stands now, the most you would pay in long-term capital gain tax is 20%. That's the max, plus the 3.8%. That's federally, so 23.8%. Under Biden's Green Book, if you sell a capital asset and that bumps your AGI, your personal adjusted gross income, above $1 million as a married filing joint couple, or if you're single, if it bumps you above $500,000, okay, so this means that your capital gain puts you above one of those two thresholds. Every dollar above that threshold in long-term capital gain will potentially, once again, this hasn't passed yet, but will potentially be subject to 39.6% long-term capital gain tax. So every dollar up until $1 million married filing joint, or every dollar up to $500,000 for a single individual, will be subject to 15 or 20%, the normal long-term capital gain rate. But if you don't 1031 exchange that property and that capital gain bumps you above $1 million married filing joint, or 500 grand single, every dollar above that in capital gain, 39.6%, plus the 3.8% net investment tax, and wonderful state of California, another 9.3+% in tax. So you're looking at what? Over 50% of your long-term capital gain tax being paid back to the federal and state agencies. It is absolutely insane. I can't even stress this enough. I mean, you're looking at something that could significantly alter the real estate industry from a sale perspective completely, especially if that capital gain is on an investment that you've owned for 20, 30, 40 years. I mean, you're looking obviously at a pretty sizable gain if you've held property for that long. So then people naturally think, okay, well, I'll do the 1031 exchange. We'll talk about some potential changes there as well. But I'll tell you right now, first and foremost, 2022 will be the year for planning. I know that planning has always been important in the past, but if you fail to plan in 2022, once we have this the 100% finalized tax bill in our hands, if you fail to plan, guess what? You're ultimately planning to fail, because you're not going to be set up the right way. You're going to pay, in some situations, 50+% of your income back to Uncle Sam if these parts of the code do pass, which I do. Unfortunately, I do believe that this capital gain tax change will pass. I do believe that, I mean, the Biden administration is very, very, very honed in on the $1 million earners and the single individuals making over 500 grand. And they don't care if it's capital gain in the stock market. They don't care if it's capital gain in real estate. They want to hit people with that higher tax rate. Once again, how are they going to make up all of the money that they've printed over the last 2 years? This is very much the direction that they're going to go in. So,
yeah. So Tony, one of the plays our bigger group of investors utilize is they buy their asset, they recognize appreciation, and then rather than sell that asset, they pull some cash out of that asset, which is tax-free. They'll take that cash out through a cash out refi, reinvest that. And then if it ever gets to a point where the market's right and they're going to sell, to avoid the 52%, they'll 1031 into another asset. We have some investors that have been doing this, exercising this discipline for over 30 years and have not paid the tax, but have got the benefit from the cash out. Yep. Talk a little bit about that. You see any challenges there?
Sure, absolutely. So I love, well, first of all, top 3 rules in business, right? Number 1, pay your employees, because otherwise they'll take you to court and you're done at the end of the day. Pay your employees. Number 2, reinvest profits back into infrastructure, right? Number 3 is usually pay as little tax as possible by exercising number 2. But I also throw in as a 3rd rule in business, always use other people's money to make money, right? So when you have tons of equity in your property, you are sitting on somewhat of like a little bank account. A lot of people look at debt as, there's a whole world of investors that look at debt as a bad thing. And I understand their perception. I understand the perception of debt, especially if you have a paid off property and you're cash flowing. Why would you ever mess that up, right? Especially in retirement, people in retirement, they don't want to buy more property. So it tends to be a little bit of an older generation model to have completely zero debt on property. But if you are getting ready to build your real estate wealth, or you're already well on your way to building your real estate wealth, and you're looking to purchase more property, you need to tap into equity in your property to have larger down payments and be a player in the wonderful game of real estate acquisition. The benefit here is that you are not paying tax on the equity essentially distributed to you from your property, because you are borrowing, you're leveraging that asset to acquire debt. The interest is, because it's on an investment property. Primary residencies see some limitation on equity line of credit interest and whatnot, but because this is business interest, it's investment for rental property use, the interest is tax deductible for your real estate rental investments because it's business interest. And now you are able to liquidate some of that cash equity and purchase more real estate. Sure, you are carrying new debt on this property, but once again, if your property was cash flowing like crazy, and you needed additional deductions, especially with interest rates where they're at nowadays, you're obtaining another write-off and cycling that debt into another property, which then increases your depreciation write-offs, your mortgage interest deduction on the new property, insurance improvements. This is the way that people capitalize on building wealth in the real estate field. The most common asset amongst the 1% is real estate. I do tax returns that make $100,000 a year. I do tax returns all the way up to $25-30 million a year. So I see a wide, we here at Robert Hall and Associates, I'm not saying I'm not singling myself out, but we at Robert Hall and Associates, we see a very wide spectrum of revenue earners in all 50 states, because we prepare taxes in all 50 states. And the most common investment amongst those 1%ers is real estate, whether it be commercial or residential, mostly residential actually, but commercial as well. And that tells you something, that tells us something, that the significant way of building wealth really doesn't come solely from those AMC and GameStop options that you see, these meme stocks in the stock industry. It's consistently reinvesting money into the most consistent dividend paying investment you'll park your money in. Whether the economy is good or bad, people will always need a place to live, right? They won't always need their GameStop stock. So this is a very great way to build and capitalize on wealth by borrowing against property equity and utilizing that as larger down payments to be a cash player in this game, where I talk to probably 8 or 9 realtors a day doing taxes and answering questions for real estate professionals. And most of them are still seeing all cash deals, at least here in the state of California, which blows my mind. Buying a house for $2 million, well, of course, all they have to do is show funds before close. And then as soon as they close on the deal, they can refinance the loan. And now they've got equity out of their property and they go off and buy real estate. So we see a lot of people buying 2 properties kind of at the same time, because they are proving that they have enough funds to buy this property, and then they refi and go on from there. But debt, in my mind, is never a bad thing as long as you are not over leveraged, right? That's kind of the common consideration of debt and leveraging.
Yeah. So Tone, we talked a little bit about people working from home and COVID, and what we've seen at Civic is we've actually seen a lot of our employees leave the state of California because they could, not just because their dollars stretched further, but to avoid the state tax. So high income earners are saving themselves 13-14% on the non-state tax states, and as much as 10% on the smaller ones. Anything they should be concerned about, or anybody else thinking about the state of California truly moving to another state, picking up residence, kids going to school, driver's license in that state? Or is it really more of those that are playing the 6 month and a day game? Can you talk about that a little bit?
Sure. So there are options here. The government really would like people when they choose a state of residency. So remember that you have to choose a state of residency. If you are in the midst of moving, there might be a part year or a non-resident filing of the return, but eventually wherever you settle on the tax return filing, on the personal return filing, you do have to check a box for your primary residence state. And so you need to be aware that the federal government's going to very much look at that. If you're doing this in a high income bracket, they're going to wonder, okay, did you do this solely to avoid paying state of California income tax? Now, California doesn't really audit. There are very few scenarios where we've seen California kind of step over that line and audit individuals. And most of the time it's for auditing payroll taxes through a business. The state of California doesn't tend to audit, but if they do see a high income earner moving out of the state of California, they may actually reach out to the IRS and say, hey, listen, we want you, big brother, to step in and figure out if this is a legitimate, a taxpayer moving out of state, registering to vote there, driving around cars with Nevada or Texas plates, simply to avoid a large capital gain tax implication in the year of disposition as a resident of another state. Very, very common. In fact, we called it in 2020, we called it the mass exodus year here in our office and probably in the tax industry as a whole. But we saw more people move out of the state of California in the year 2020, once again, than in the 17 years that I've worked in the tax industry. So I called it mass exodus, and there was a lot of restructuring for our clients. We tended to see more people moving who were in the $500,000, $600,000, $700,000 range, not individuals in the $100,000 to $200,000 range. We had some of those as well, but remember that the federal government wants to make sure that if you are avoiding California income tax, well, actually the state of California, not the feds, but if the feds audit, they're going to do it on behalf of the state of California. California wants to make sure that you are living in that other state for more than half a year and 1 day, right? Because they want to make sure that more than 51% of the time, roughly 51% of the time, that you reside in that state. Now, what power does the state of California have under audit to prove state of residency? They can audit credit card transactions. They can audit cell phone bills. I've even heard that the state of California can pull cell tower data to see where your cell phone calls were coming from. Now, I think that's a little bit of a conspiracy, personally speaking, but I've heard these really, really strange stories under audit. And understand that they're going to look at utility records, once again, cell phone, telephone, where your, GQ magazines are being mailed to, your name on the magazine and everything. So if you are truly trying to avoid, not evade, remember, tax avoidance is legal, completely legal. Tax evasion is not. So if you are properly trying to avoid paying tax, you need to play the game. You have to register to vote in whatever state you're moving to. You have to drive around cars with Nevada or Texas or whatever that state is with license plates on your vehicles. Your driver's license has to be a Nevada or Texas driver's license with a Nevada or Texas address on it, or Florida, whichever state you're moving to. And that is how you truly play the game. Now, does that get you kind of in the clear with the state of California? Well, one very unique thing about California is California taxes its residents on their worldwide income. Okay. So if you have owned a real estate rental investment here in the state of California for, let's say, 20 years, and you've never paid capital gain tax on it here in the state of California, you've never paid depreciation recapture tax in the state of California, and you decide, I'm done with California, I want to exchange this property for properties in Texas and Florida and Wyoming and Delaware, all across the US. So you take this, $5 million Burbank residency or Hollywood Hills residency, and you exchange it for 50 other units across the US. The state of California says that that's fine with us, but when you exit out of California, you have to file a federal exchange form, which is something that we do, and a California exchange form. California will follow those investments from here until the end of time. So if you ever sell any one of those other state residencies, California has a clawback clause, which if you own those properties elsewhere in the US for another 10 or 15 years, California says, okay, when you sell those, you're good on the 10 to 15 years of appreciation after you left the state of California, but the 20 to 30 years that you deferred the tax on, we are going to claw back all 20 to 30 years of capital gain tax and recapture depreciation tax on any investments that you sell that are no longer California investments. California is a very unique state, very similar to New York, but California is the highest tax state in the US. They play by a very, very specific set of rules. And if you do taxes with somebody who doesn't understand that, I guarantee California, I've seen this before, California, when they track you, don't think that you can avoid California, because this information gets reported to the state of California by who? By the federal government. So they have a deal with the feds to detail the transaction to the state to make sure that they are tracking all of that information on a year-to-year basis. So just be very aware that it is possible, but in order to play the game, you got to check all the boxes, cross your T's, dot your I's, and we can absolutely assist with doing that.
Yeah, look, I think people are genuinely moving. Those that are moving are registering. They're getting their licenses, their phones, their bills, their bank statements. Everything's going there, and that's great. You mentioned 4 or 5 or 700,000 a year, 300,000 a year, saving 14%. What, $42,000 a year, and $42,000 a year buys a lot of house in some of these non-state tax states. So, yeah, it's I get the move. I understand the financial play and the dollar stretching a little bit longer. But then I think you have a whole host of individuals that are going, okay, I still like California some, I just don't like these parts. And so it's the 6 month and a day that you clarified. And I appreciate that, because I do think there's a lot of folks, maybe even on this call, that fall into that bucket a bit.
And remember, even if you are living in another state and have California investments, the non-resident tax rate in the state of California is much less than the full year resident state tax. So even by living elsewhere and still having California investments that you're tied to, it's still going to be less overall income tax than if you lived here full year, 12 months out of the year. Non-resident state taxes can be upwards of 4.2, 4.5, 4.6% versus 10.3 to 11% if you're full year resident and you're a high income earner. So you'd still be cutting your actual income tax on the state side by over 50%, even if you kept your California investments and moved elsewhere in the US. So there's still some games to be played with that as well.
Yeah, agreed. So looking at the clock, we got 15 minutes. I have one question and then we'll go to Q&A, Gina, if you're starting to accumulate those. 3 things real estate investors should think about right now as we sit here in early 2022, pre any tax change. Give them 3 gimmies right now.
Sure. So one thing that I want to make sure of is elections on your return. I cannot stress this enough that people go into tax season and don't really know what their rights are as real estate professionals, as medical professionals, as finance professionals. There are special elections on your return that will qualify you, even though your income is above certain thresholds, qualify you for major tax benefits like the QBI deduction that it was introduced in 2018. That qualification alone, if you are checking the wrong boxes, could leave 20% of your non-passive or passive real estate income on the table paying as tax, meaning that if you've got 100 grand in cash flow from your real estate investments and you are under the qualifying threshold to qualify for QBI, but you're not making the correct elections, that's $20,000 of non-taxable income that you're leaving to the federal government. So there are special elections for QBI, for real estate professionals, especially for the married filing joint individuals where maybe one spouse is killing it in their industry, making $1 million+ and the other spouse might be working from home and not really gaining too much traction in maybe the self-employed world. So why would we not play the game to make the spouse that has lower income a real estate professional, fully allowing the dollar for dollar loss deductions through the real estate investments, while the other W-2 wage spouse unfortunately wouldn't, well, fortunately, because they're high income earners, but unfortunately wouldn't be the qualified real estate professional. If you're single, can't really play that game. But for married filing joint couples, especially in retirement, when you're receiving all of this unearned retirement income, make sure that you are correctly making these elections to allow these real estate sheltering deductions to pass through to you individually. Let me give you an example, just a really quick example. Let's say your main W-2 income is in the medical field, right? You've got and I see this a lot, medical professional making $1 million W-2. Spouse might have been in the medical field, but maybe they started a family or started a business. So they left the medical field and they have very low income individually on the spouse's side. Well, simply because the spouse who's making the $1 million, simply because of that, they fully phased out from being allowed any real estate related loss deductions. As soon as you breach 150 grand of adjusted gross income, any loss deductions through rental properties disallowed. But if your spouse, the one that has the no income to little to no income, if that spouse is a real estate professional, an active manager of the real estate portfolio, a licensed real estate professional, maybe a realtor who just signed up and is getting their feet wet in the real estate industry, if they are in charge now of the real estate portfolio, and let's say that rental property portfolio is showing 100 grand or 200 grand in losses because of depreciation, improvements made to the properties, mortgage interest, all of the deductions that you get, that $200,000 loss is now a dollar for dollar offset to the $1 million W-2, because it's not just based on AGI, it's based on one of the spouses being a real estate professional. Now, you just don't want to go into your tax return and start checking boxes to see what increases your refund, because that election, very much like the in-home office form, that election for real estate professional status runs about a 75% chance for audit, because you are telling the government that unlike 90% of other real estate investors out there, you actually are a real estate professional. You don't have to be licensed. I know a lot of real estate investors who own 20, 30, 40 properties that are way more considered to be professionals than a licensed real estate individual, licensed realtor. So you don't have to be licensed, but you have to meet what's called a 51 rule. You're not going to read about this in the Internal Revenue Code, but under audit, we talk with agents a lot about this and kind of bounce ideas, not under audit, but bounce ideas off agents about this. And what they really look at for the real estate professional election is a 51% rule, meaning where does 51% or more of that spouse's income come from? Or where is, and I'm sorry, not or, but and where is 51% or more of that spouse's time spent? Is it spent in the real estate industry? Is it spent in the medical professional industry? Is it spent in the entertainment industry? So if that 51 rule can be met, the spouse that isn't the high W-2 earner can invest in real estate with the high income that the spouse is making and allow those real estate losses to offset the W-2. This kind of comes full circle to planning, right? This is all proper planning before the end of the calendar year. So 1, elections. 2, build a team around you, have real estate, have lending specialists, have tax professionals who understand what lenders are looking for from a lending perspective. Just yesterday, I did 2 returns, preliminary returns that we PDF'd over to the client so that they could provide to their lenders, right? So we are not deal killers. So we have to plan ahead if you plan on building wealth in the real estate industry. That's number 2. Number 3 is always make sure that you understand your deduction rights, right? I mean, always understand that whatever is in the current play for you, not under the new tax code that could potentially be on the horizon, but currently what benefits you can exercise still for even 2021, maxing out SEP IRA contributions, deferring money into profit sharing plan contributions, doing whatever you can to further reduce that liability in past years, but also understanding that if you are self-employed, maybe this year would be the right year to incorporate your real estate investments or incorporate your real estate commission business, or looking for not only entity selection help, but also how to properly structure this fast growing business that you're starting up, how to incorporate and retain more of that profit before the end of this calendar year. I know that it's only February 15th, but that also means to me that we have a lot more time to plan. People still don't understand how the car deduction works, the accelerated depreciation right off there. People don't understand what QIP is, qualified improvement property. I went into that a little bit. People don't understand about cost segregation and the benefit behind that. Some of you, hopefully most of you, will qualify for these benefits, but some of you might not. If you're not a real estate professional and both you and your spouse are surgeons, right, and you're making $1 million each of you, your real estate losses will not be allowed as a dollar for dollar offset to your income. But if one of you qualifies for it, you can be a major tax shelter for the other spouse. And let's face it, you're on the joint tax return, so it benefits both of you. So proper planning, please. That is probably the one thing I want to leave you with today, is just plan ahead. In 2022, I think planning, it's always been popular and important in the past, but I believe that planning will truly be the thing that saves us in 2022 from all of these potential changes on the horizon.
That's awesome, Tom. Gina, we got, what do we got, 5 to 10 minutes for Q&A?
5 to 10 minutes and not enough time. So 1031s are a very popular topic. Lots of questions on those. So I'm going to try to bundle a couple into one for you, Tony. So let me regroup here. So the first question is more of just a clarification that there is no depreciation recapture with the 1031. Is that accurate?
That is true. If it's a equal exchange, so like kind exchange, meaning same dollar value for same dollar value, but also knowing that you need to carry the same amount of debt, and also in an up leg exchange. If you're doing a down leg exchange where you are taking boot from the deal, there will be an adjustment to the depreciation recapture. So once again, the whole point of a like kind exchange is to defer tax on both the capital gain side and the recapture depreciation side. So yes, in a like kind exchange, you are not paying any income tax on depreciation recapture.
Equal or greater?
Equal or greater, correct.
Okay, and the next question ties into any legislation for extending timelines. Just the current time frame being so short. Is there anything that you have heard murmurs of, anything on the horizon, any pending legislation or lobbying to possibly shorten that time frame?
So like I had mentioned earlier, we do a lot of webinars. And so there are a lot of people I come across that have opinions about things and things they've read online. I'm going to tell you right now that whatever you've read online, if it wasn't at irs.gov, actually on the IRS website, you can't really believe it, because there's a lot of misinformation. Obviously, we know there's a lot of misinformation online, but the 1031 exchange topic, what I had heard from one website and one client on a webinar, is that they have tabled the conversation of changing the section 1031 of the Internal Revenue Code. At the moment, we are looking at not only the same timeframes, 45 days to identify property, and then including the 45 days, 180 days to actually close on the 1031 exchange. However, there are special elections, and once again, there has to be life-changing disasters. So the government has to deem a part of the U.S. a federally federally declared disaster zone, or I forget the exact term, but that may allow you to extend exchange times above and beyond the 180 days by 120 days. Now, not everybody qualifies for this, so you need to specifically read what the qualifications are for this 120-day extension. That was available in 2020 because of the pandemic, especially here in the state of California with the fires in Malibu, and we have fires all over the place. It seems like California is always burning something. But as far as the extension of that, you have to qualify for that extension. Now, under the new Internal Revenue Code, the federal government is talking about limiting the overall gain to $500,000 per taxpayer. So married filing joint would be limited to $1 million. Single individuals limited to 500,000. That has not passed. I personally don't believe that that's going to pass, because that would also impact the capital gain tax implications that we talked about earlier, where if you do have to pay tax on the overage of the gain and it puts you above 500,000 or $1 million, married filing joint or single, obviously you're going to be paying 39.6% long-term capital gain tax on that, plus recapture depreciation. So I don't believe that part of the code is going to pass. Your specific question about deadline or timeframe extensions, there are very, very unique scenarios that will allow you to exchange the 1031 180-day timeframe, but not everyone will qualify for it. So before you think about going over the 180 days, have this conversation with your tax advisor. Make sure that you are living in an area that was declared a federal disaster area or federal disaster zone, like a fire zone, earthquake, tsunami, so on and so forth. It has to be life-changing, those kind of situations.
Okay, so can you also explain, still speaking to 1031s, what amount of the sale proceeds need to be rolled into a new purchase in a 1031 exchange to avoid capital gains tax? Is it the sale price, or can any expenses be deducted?
So this is why I feel like I'm gainfully employed, because it's not as simple as just looking at the sale price and rolling that into another property. If you want the bare bones of what's supposed to happen, you take the sale price, you take the overall gain minus non-recurring closing costs, and that is the number that 98% of the time needs to be cycled into another investment. However, the reason why the general taxpayer here in the United States can't do 1031 exchange tax returns most of the time, some of you might be able to, is because there is more to the calculation than just taking the sale price minus your basis, minus the closing costs and the improvements, and figuring that that's the number that you need to cycle into another investment. You also need to adjust the new basis in the property that you're acquiring by the recapture amount of depreciation, because you are avoiding the income tax on that depreciable amount. So we have a whole calculator in our system that we developed. This is like intellectual property for Robert Hall and Associates, through just using an Excel document, where we have this calculator where we plug in the sale price. And especially if you're doing 2 properties into 5 properties or 10 properties into 2 properties, you can imagine that the basis adjustment in the new properties is going to be significantly different if you're going from 10 to 2 or 2 to 10 real estate investments, or even just 1 to 1. So the whole point of the exchange is to defer the full gain into the new property and either acquire debt or carry the same amount of debt. And that's what allows you to have no boot and no taxable event in the exchange. However, I've seen clients think that they've deferred the full amount because, they've been able to, deduct improvements through escrow, but not through the exchange or right up until the point of escrow. And they're trying to deduct those expenses to offset any future gain. There is very much a timeline that you need to follow, not the 180-day time frame, but a timeline for acquiring debt on the property prior to the exchange, not to do really anything during the exchange time frame to mess or alter with the deal, like changing title during the exchange process. All of a sudden you fall out of the exchange, you got to pay the capital gain tax because the property that you're selling has to be acquired title-wise the same as what you are trying to exchange. So there are a lot of rules to follow in the exchange world, and the calculation is a little bit more complicated than just taking the sale price minus your basis, minus the closing cost, minus depreciation. But in theory, it's not like if you sell a property for $2 million, you don't have to buy a $2 million property. That's not how it works. You have to adjust that number to figure out what the taxable gain is going to be. And then you need to calculate what out of that amount needs to be cycled into the new property. If you are acquiring more debt on the exchange, sometimes you can access money from the exchange and not pay tax on it because you're replacing it with acquired debt. So there are up leg exchange, there are down leg exchange, there are like kind exchanges, and they are all reported differently. They are very complicated calculations. So I would suggest that you probably talk with a tax advisor about what dollar amount specifically needs to be cycled into a new investment.
Okay. Do we want to take one more, Bill?
Please.
Okay, so this one is twofold for the both of you. From a lender's perspective, do you see most of your investors investing in an LLC? And for Tony, does that jive with what the majority of the borrowers are doing for Civic?
Yeah, well, so I'll take a stab at that, Tony, and then I'll pass it on to you. About 75% of the $1.7 billion we did last year was done through LLC. These are, just think about it for a second, these aren't consumer loans, these aren't owner-occupied homes, and they're not vacation homes. These are investor loans. And so most of them layer, but through different means, LLC, additional layer of protection. And so we don't require PGs under a certain loan amount. Most of those loans are under that certain loan amount, and it does allow for more than one member to be on that property. So yeah, LLCs represent 3/4 of what we do today. It's not requirement, but it does seem to be the dominating way that people are taking down real estate. Tony?
Sure. As a firm, out of the thousands and thousands of LLCs that we prepare on a year-to-year basis, we have seen a very consistent model from a limited liability company incorporating perspective. People are not incorporating as an LLC to save tax. I want to make sure that everybody understands that LLCs save you absolutely nothing in income tax. They are only to limit liability. I have always been a believer, doesn't matter how much equity I have in my property, doesn't matter how much debt I have attached to the property, doesn't matter my cash flow. Personally, when I first started investing in real estate, I understood very early in my career because I had great mentors. My father was a real estate investor. My grandfather developed like 50% of Old Town Tucson back in the 20s and 30s. I mean, some buildings that are over 100 years old. So I came from a real estate background. And then Bob Hall, who was my mentor here at the firm, I always understood that you don't ever want to put all of your eggs in one basket from a business perspective. And so I get the question a lot, should I start one LLC and put 10 properties in it? Should I have an LLC for each one of my properties? And at the end of the day, I don't think that it really is my idea to advise you on this, because LLCs don't save you tax. They are only liability protecting assets or liability protecting entities. But I personally believe that if you have a cash flowing investment, LLC should absolutely be in place to limit liability. Not everybody needs LLCs. That's why I don't want to tell you all to just leave this webinar and go start your LLCs. This is very much something kind of a two-part advisory kind of perspective, where one, you definitely want to talk to an attorney to make sure that you're getting the full-blown liability protection you're looking for, and then also talk about the filing implications with your preparer. The difference between a multi-member LLC and a single-member LLC. Multi-member LLCs file a completely separate tax return called a 1065 partnership. So you're adding, not only here in the state of California, at least least a higher filing fee by having that separated entity, but also a preparation fee involved in that. And then you've got the single member LLC, which files with the individual tax return, still has the California parking ticket. I call it the parking ticket, $800 per year, but at least you're not filing a separate tax return aside from the personal return. So from a tax perspective, you need to understand the financial obligations of starting an LLC as well. So liability protection, more of an attorney question. Income tax side, you're not saving anything income tax wise. But once again, do not try to put all of your eggs in one basket. These properties are high valued assets that you own. And as you build equity in those properties and start to cash flow, they deserve to be protected in their own LLCs. So I can tell you personally, I would never put two properties in one LLC. I have an LLC for every single property that I own, that my family owns, that my brother and myself own, and his partners own. So we want that liability protection for peace of mind that if anything happens, we have that in place to protect that asset separately from everything that we own personally. So once again, LLCs, great liability protection entities.
And on that note, I will say, I mentioned it previously, the episode that Tony joined us for back in May was titled The Power of Inc., INC. And in that episode, if you go back to civicfs.com/industry insights, you can rewatch that episode because he does a deep dive into the different entity options that there are and the different tax implications, benefits of each. So that's excellent. Bill, we are at time. So I put it in the chat, but for those of you on the call listening in, if you want to set up a private consultation with Tony and his team at Robert Hall and Associates, you can email him directly at tonywatson@roberthalltaxes.com. And I did throw that in the chat. Thank you so much for joining us. Third time is a charm. Bill, do you have any closing remarks for Tony?
No, he's wonderful. You know how I feel about you, Tony. It was that hour went by so fast. If you think your tax returns are buttoned up, I promise you there's something in there that you haven't thought about. It's worth reaching out to Tony and having that conversation. There's really, I've met nobody better in how they think about real estate and your well-being and applying the tax code the way it's supposed to be applied. So thank you, Tony, for joining us again.